Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss seasonality in the Crisis Hedge Portfolios.
Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. Today I would like to discuss seasonal patterns in Crisis Hedge Portfolios. Firstly, let's discuss what's Crisis Hedge. So the Crisis Hedge is a trading strategy or investment portfolio which is built from some underlying assets that can work as a hedge in equity market downturns or in drawdowns. So when you have a crisis, it can be geopolitical crisis, it can be economical crisis, financial crisis. Some of the assets perform very well. It can be the gold, it can be US treasuries. Some of the assets they usually do not perform so well, cryptocurrencies or equities. You can use the assets that perform well as a crisis hedge. So if you mix those assets into your portfolio, the overall quality of the portfolio or return to risk characteristics will be better. Now we have quite a few, or 150 strategies that are crisis hedge strategies in our database. What we did in previous week is that we have an article about the seasonality patterns in those crisis hedge portfolios. This article builds upon another article that we wrote in the past 2 months. We discussed the commodity seasonality. So we discussed what is the impact of the seasonality on the performance of the commodities and how you can front run this seasonality. So how you can find out what time of the year is the best to invest into individual commodities and how you can front run these signals, these seasonality signals in the commodities. That was the idea in the commodities, and we tried to use this idea how to front run seasonality, but not use this front running of the seasonality in the commodities, but in the crisis hedge portfolios. As we mentioned before, these crisis hedge portfolios are very great to hedge your portfolio in a crisis. Now, if you are interested into those strategies, we have a dedicated page, trading strategies for bear market, and you can also read about them on this individual subpage. Let's get back to seasonality patterns. What's our data and what's our methodology? So we took 6 ETFs which have a crisis hedge characteristics. Those are the ETFs of the assets that perform plus or minus very well when there is a crisis. So it's a Swiss franc, a Japanese yen, US dollar index. So those are 3 currencies that perform very well when there is an international crisis. Then there is a gold, 10-year treasury bond ETF and 20+ year treasury ETF. So we have fixed income ETFs, we have the gold, and we have a few of the currencies that work very well when there is a crisis. So this is our investment universe. Now, what is our idea is to find out what are the seasonal patterns in those ETFs. If there are some patterns when the investors prefer to hold those ETFs, and we can find them in the data. Another idea is that let's try to front run these seasonal patterns. So there are multiple types how to identify seasonality patterns. One of them is time series seasonality. It is similar to our commodity study, so to our previous article. So you take the whole history of the individual asset, you check the last 12 months, and you identify whether the month that's 12 months ago. So for example, at the moment it's end of the January and you want to buy the February asset, you will take a look what is the February performance of the asset in the past, the previous year, and you will compare that February performance to the rest of the years, to the rest of the 12 months, and you will check whether it's higher than some median performance or some average month. If it's higher, then you invest into this asset. If it's lower, then you do not hold this asset. So this is the time series seasonality, and if you want to front run this seasonality, then you do not take a look 12 months ago, but you are looking 11 months ago. So that's the front running. If you want to learn more about the front running, really go to read the guide to front running commodity seasonality. So this is the article that will discuss just the front running. Then you have the cross-sectional seasonality. So what is the cross-sectional seasonality? So let's imagine that once again we are at the end of the January. We want to know what assets should we hold in the February. So let's take a look on the February performance, but right now take a look on what's the performance of all of the assets in the February, and let's hold those that have the strongest performance, and you can short those that have the weakest performance the previous year in the February. So that's the cross-sectional seasonality. Once again, if you want to focus just solely on the true seasonality, you are checking at the end of the January what is the February performance. So you are going 12 months into the past. If you want to front run, you are going 11 months into the past. So 1 month less. Let's take a look at what are the results. We have the benchmark. So what is the benchmark? The benchmark is equally weighted investment universe. So let's imagine that this is the benchmark. This investment universe usually performs very well when there is a crisis. You can see that in 2010, 11, when there is a European Union crisis, those assets perform very well. Then we have 2012 2020 when there was a COVID crisis, those assets performed very well, etc. So I mean, those assets performed very well during the crisis. So a benchmark portfolio is just holding those ETFs equally weighted. Now, what is the true seasonality portfolio? The true seasonality portfolio is the portfolio when you buy the assets based on the previous 12-month performance. As I discussed before, you will take a look at the individual asset. At the end of the January, you will check what was the performance in the February previous year, and if it was higher than the median performance over the last 12 months, you will buy that asset. So that's the true seasonality. As we can see, the true seasonality is not performing very well. What is the front running? The front running is that at the end of the January, you are not looking on the performance in the past February, but you are looking at the performance in the past March, because you expect that over the February, the people will start to buy crisis hedge assets that perform the best in the March, and you would like to front run this signal. So you need to buy it 1 month sooner. So at the end of January, you're looking at the March performance, and you are buying those assets in the end of the January because you want to hold them in February. That's the front running. As we can see, the front running performs really well. It has nice Sharpe ratio, nice return to risk ratios, etc., etc. So it makes sense to front run the signals, not just in commodities, but also in crisis hedge portfolios. You should front run the seasonal signals also in a portfolio that consists of the ETFs that have the crisis hedge characteristics. And what about the cross-sectional seasonality? So once again, what is cross-sectional seasonality? At the end of the January, we're looking on the cross-section of the performance of all of the ETFs in the February. Firstly, we will try to front run this signal. So at the end of the January, we are looking at the cross-section of the performance in the previous March, and we are trying to buy those assets in the end of the January and hold them in the February. When we are doing the front running of the seasonality, our performance outperforms the benchmark. It doesn't matter if we do it long only, so we buy only the best performing assets. We are outperforming the benchmark also when we do the long short, but also the long short portfolios are not so good in this case, because by shorting we are increasing the risk in those portfolios, so we have higher drawdowns, higher volatility. So I mean, it's better to just perform the long only front running, so buy only assets for the long only portfolio and do not short the assets that do not perform well in the previous March. Here we have a table. Once again, we can see that when we are front running the seasonality signal, we have a nice Sharpe ratios, we have a nice return to risk ratios, and also we significantly outperform the benchmark. Once again, the benchmark is just holding those assets all together equally weighted. And how does it look like when we do not do the front running, when we just buy based on the seasonality signal? What is that? Once again, at the end of the January, we want to buy something that performed well in the past February, because we expect it will perform well also in the current February. We are going the long DTS with the best performance in T-12 month. Yeah, with the long only portfolio, we are outperforming the benchmark. With long short portfolios, we are not outperforming the benchmark at all, but we have significantly worse Sharpe ratios, significantly worse return to risk ratios compared to the case when we do the front running. So what is the conclusion? So the conclusion is simple. Firstly, the crisis hedge in ETF universe works very well. You can use the crisis hedge ETF universe to actually improve the performance of the assets that are sensitive to business cycle, like equities or cryptocurrencies. It makes sense to not just hold the equally weighted investment universe, but to perform the seasonality strategy, because you can improve the performance. But simple, naive, or pure seasonality signals do not outperform the benchmark. You need to front run those signals. The front running is really pervasive among the assets, so it's the front running very well, not just in the commodities but also in the crisis hedge portfolios. So it makes sense to incorporate this seasonality and front running of the seasonality into your crisis hedge portfolios. When you then use those crisis hedge portfolios with implemented front running of the seasonality, and you mix those assets or strategies with your risky assets like equities or cryptocurrencies, you can significantly improve the performance, and your asset allocation will be significantly better. That's the final outcome of our analysis. I hope that you liked this short video. So the whole article is available for free on our blog, so please you can go to our blog, you can read the article. I can also recommend you to read the Trader's Guide to Front Running Commodity Seasonality. Once again, it's more about how to build these seasonality portfolios that are front running the seasonality signals. And if you want to learn something more about the crisis hedge portfolios or how to hedge your portfolio in a crisis, you can go to our trading strategies for bear markets subpage when you will learn something more about that, or you can screen the crisis hedge strategies in our screener. There is special field for that. You just select the crisis hedge and you just select the yes, and you will find the strategies that will hedge your portfolio in the crisis. So thank you very much. I hope that will give us the like. I hope that you will check the other videos, and please visit our website. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.